Apple is one of the most recognized brands in the world, and the iPhone is one of the most popular products of all time. That being said, investors are curious about Apple stock. But how much is Apple stock really worth? If we were to conduct a discounted cash flow valuation of Apple, what would the intrinsic value per share be? That's the question I'm going to answer in this video. I'm going to employ several estimates and assumptions to make this prediction. As always, I will share with you precisely where I'm getting these numbers from so that you can make your own decisions on whether or not this calculation is accurate, too optimistic, or too pessimistic. Let's get into the details. I want to thank The Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now. All right, one of the numbers I'm going to need is its current market price at $225 per share as of this recording, so that we can compare our intrinsic value per share to this market price to determine if the shares are undervalued, overvalued, or fairly valued. The next number I need is Apple's trailing 12-month free cash flow. That was $104 billion as of the most recent update. And then Apple's diluted shares outstanding, which are 15.81 billion. You can see the share count dwindling over the last decade as Apple has employed hundreds of billions of dollars buying back their own shares, and they plan to continue to do that over the next several years. As you notice, the company generated over 100 billion in free cash flow. Apple doesn't have profitable use cases for all of that money internally, so it wants to return that money to shareholders through dividends and buybacks. The next number I need is Apple's long-term debt, which stands at $101 billion. And here's a good point to highlight that Apple has been increasing its debt. You can see in 2015, it had about $45 billion in debt, and it now has over $100 billion in debt. And you might be thinking to yourself, doesn't that contradict what I just said, that Apple has so much money it doesn't know what to do with it, and yet it's borrowing money? What gives there? And this points to an interesting conclusion about a company's weighted average cost of capital. The cost of debt is usually much lower than the cost of equity. So when a company is borrowing money to buy back shares of stock, it's readjusting its capital structure to make it more based on debt and less on equity, which lowers the weighted average cost of capital, which we're going to see in my valuation calculation, how that increases shareholder value. Apple's market cap, $3.429 trillion in a remarkable increase over the last decade. Apple's market capitalization has soared. And finally, I need the cash balance, which stands at $25.57 billion. For my growth estimate, I'm going to use the Wall Street Analyst estimate for Apple over the next 5 years for earnings per share growth of 11%. Now, this is considerably slower than the 19% earnings per share growth Apple achieved in the previous 5 years. So in my opinion, the Wall Street estimate for Apple's growth is understated. I would say the growth rate could be closer to 13-14% over the next 5 years compared to the previous 5 years where it was 19%. So I would adjust downward the previous 5-year growth rate by 500 basis points down to 14.28% if I was using my subjective growth rate estimate. But I'm not going to do that in this case. I'm just going to use the Wall Street estimate for Apple's growth over the next 5 years. And then I'll do a scenario where I employ my estimated growth rate, and we can see what the difference is in valuation based on the differing growth rates I employ in the valuation. All right, so now that we have the numbers we need to make our calculation, we can deploy our model. Let me first draw your attention here to the free cash flow for 2024 of $104 billion. I got that from Wild Charts. It's Apple's trailing 12-month free cash flow. I forecasted these free cash flows for the next 11 years using various growth rates. The first growth rate, the short-run growth rate, I used 11.1%. That was from the Yahoo Finance growth rate expected for Apple's earnings per share over the next 5 years. The 5 years after that, I have Apple's growth rate going down by 50% from the previous growth rate to 5.5%. And then for the long run, I have Apple settling down into a growth rate of 5%. And so if I employ those rates of growth, I derive these free cash flow estimates going all the way out to the year 2035. Of course, we need to discount those cash flows because money in the future is not worth as much to us as money today. And the discount rate I used is the weighted average cost of capital of 10.95% for Apple stock. Now, I derived the weighted average cost of capital employing the capital asset pricing model for the cost of equity with the beta of 1.24 I got from Yahoo Finance for Apple stock, a risk-free rate of 4%, and a market risk premium of 6%. That gave me a capital asset pricing model cost of equity of 11.4%. Now, I adjusted the company's capital structure to be 90% equity and 10% debt because I consider Apple shifting its capital structure more towards debt because of the lower cost of debt. You can see here Apple's cost of debt I have here estimated at 6.5%, whereas the cost of equity is 11.44%. So the company's management will work to increase the amount of debt and decrease the amount of equity so that its weighted average cost of capital will decrease and thereby increase the company's valuation in investors' eyes. So when we get the present value of all those cash flows discounted at this weighted average cost of capital, we get a PV of cash flows of $977 billion for Apple stock. Now, when we are forecasting the cash flows from the year 2035 to infinity, we can employ a terminal value calculation using the free cash flow expected 1 year ahead, which is in 2035, divided by the weighted average cost of capital minus the growth rate, which gives us a terminal value of 4.085 trillion. Then we discount that cash flow back to today, which gives us the present value of the terminal value of 1.445 trillion. If we sum together those two cash flows, we get a value of operation for Apple 2.423 trillion. So now we're at this point here. We need to add to that value Apple's cash balance and subtract its debt. And when we make those calculations, adding 25 billion in cash, subtracting 101 billion in debt, we get a value of equity for Apple at 2.347 trillion. If we divide that with the number of shares outstanding, which was 15.8 billion, we get an intrinsic value per share for Apple stock at $148.60, which if we compare with the current market price, would suggest that Apple shares are overvalued. Now, I have Apple stock rated as a buy. Despite this calculation, partly because I have different estimates, I highlighted that my short-term growth rate for Apple stock would not be 11.1%, but would rather be 14.23% in the short term, and that would increase the transition period growth rate to 7.12%, which would lift Apple's intrinsic share value to $179 per share. Now, I have other estimates that I've changed and adjusted for Apple and other reasons why I've rated Apple stock as a buy despite this intrinsic value calculation, because this isn't the only deciding factor I use when making my investment decision. For those of you that have purchased my book, let me say thank you again. You will have seen my 6-step framework for evaluating stocks, and you'll notice that valuation is only one part of my 6-part framework. So that's why even if an intrinsic value shows significant undervalued or overvalued, it's not the only decision point I use in my framework for evaluating and deciding if a stock is a buy, hold, or a sell. As always, this is for information purposes only. I recommend you deploy this model along with other tools to use to come to a conclusion. This shouldn't be your only criteria to make a decision, and this should be included with your own due diligence. Do not take my calculations as truth. Do the calculations yourself to double check and make sure that you're happy with the numbers deployed in this valuation. Your investments are too important to just look at what I have calculated and make a decision based on that. Hey everyone, if you like watching my videos, then I've added a great complimentary product just for you. I've written a book that's available for sale now that highlights my 6-step investing framework. Even if you don't follow that investing framework, just reading it and knowing how I evaluate stocks will make it a lot more interesting and informative to watch my videos. I've added the link in the description below.